Welcome to today's Equity Research Briefing. Today, we are initiating coverage on what we believe is the most mispriced asset within the digital advertising infrastructure space, trading under the ticker symbol ADAI. While retail investors remain fixated on mega-cap tech and consumer-facing artificial intelligence, institutional capital has been quietly rotating into the back-end algorithmic engines that dictate global programmatic ad spend. Our thesis is straightforward. ADAI has successfully decoupled its revenue trajectory from broader macroeconomic headwinds, leveraging a proprietary deep learning bidding engine that structurally bypasses legacy data silos. We are initiating coverage with an overweight rating and a 12-month base case price target of $145, representing a 35% upside from current trading levels. This platform is not merely participating in the digital ad recovery, it is actively absorbing market share from incumbent demand-side platforms by delivering mathematically superior return on ad spend. To understand the quantitative upside, we must first analyze the structural market dynamics reshaping the total addressable market. The digital advertising landscape is currently undergoing a systemic transition away from walled gardens, due to the deprecation of third-party cookies and stringent privacy mandates like Apple's IDFA. We project the open internet programmatic ad market will expand to a total addressable market of $180 billion by fiscal year 2027. ADAI is perfectly positioned at the epicenter of this TAM expansion. Unlike legacy ad tech firms that relied heavily on deterministic tracking, ADAI utilizes probabilistic AI models to construct high-intent audience cohorts without compromising user privacy. Our data indicates that walled gardens are bleeding market share at a rate of approximately 250 basis points annually, creating a massive vacuum of institutional ad spend that ADAI's automated routing algorithms are effectively capturing. The core catalyst driving this alpha generation is their proprietary deep learning architecture, internally designated as the Axis 9 bidding engine. From a technical standpoint, this is a masterpiece of low-latency infrastructure. The platform currently processes an astonishing 15 million queries per second, executing real-time bidding auctions in under 10 milliseconds. But the true institutional differentiator is the predictive conversion modeling. By analyzing thousands of contextual data points per millisecond, Axis 9 dynamically adjusts bidding parameters, yielding an average 22% higher return on ad spend for enterprise clients compared to legacy DSPs. This hard ROI metric makes their platform incredibly sticky, which is reflected in their pristine net revenue retention rate. Currently stabilized at 115%, this NRR metric proves that once enterprise advertisers allocate budget to the Axis 9 algorithm, their spend compounds year over year. Transitioning to the financial performance and top-line trajectory, the revenue profile exhibits textbook SaaS-like compounding mechanics. For fiscal year 2024, our models project top-line revenue of $2.1 billion, representing a massive 32% year-over-year acceleration. More impressively, our forward projections indicate a 3-year revenue compound annual growth rate of 28%. What stands out to our quantitative desk is the aggressive gross margin expansion. Because the AI model scales linearly without requiring proportional headcount increases, gross margins have expanded from 74% to 78% over the trailing 12 months. Furthermore, they are comfortably surpassing the Rule of 40, currently operating closer to a Rule of 65 profile when combining top-line growth and free cash flow margins. Free cash flow yield is simultaneously scaling to 4.5%, providing substantial capital for continued R&D. Examining the balance sheet architecture reveals a financial fortress capable of weathering severe macro volatility. The company operates with a capital-light model and zero long-term debt, completely insulating the balance sheet from the current elevated interest rate environment. Liquidity is exceptionally robust, with $800 million in cash and cash equivalents parked in short-duration treasuries. This fortress balance sheet translates directly into operational flexibility. Over the past 4 quarters, operating margins have expanded by 450 basis points, driven by the inherent operating leverage of their algorithmic infrastructure. With a current ratio of 2.4x, they possess the dry powder to aggressively pursue strategic bolt-on acquisitions during broader market corrections. The sheer velocity of their cash conversion cycle ensures that working capital remains an asset rather than a liability, further solidifying their institutional-grade credit profile. Shifting our focus to relative valuation and peer comps analysis, the mispricing becomes glaringly apparent. Despite top-tier fundamentals, the stock is currently trading at a next 12 months enterprise value to EBITDA multiple of 18.2x. When benchmarked against the broader ad tech AI cohort, which averages an EV to EBITDA multiple of 26x, ADI is trading at an unjustified 30% discount. Looking at the bottom line, the forward PE sits at a very reasonable 24x. However, the most compelling valuation metric for growth at a reasonable price investors is the PEG ratio. At 0.85, the PEG ratio indicates that the market is severely underpricing the forward earnings growth. This multiple compression is largely a hangover from broader sector weakness, but as the market digests the structural margin superiority of their AI engine, we anticipate an aggressive multiple expansion phase to bridge the valuation gap. This valuation disconnect has not gone unnoticed by the smart money. An analysis of recent 13F filings reveals a highly constructive pattern of institutional flow and insider accumulation. Institutional ownership currently stands at an impressive 85%. More notably, during the third quarter, we tracked a 12% sequential increase in exposure from Tier 1 hedge funds and quantitative asset managers. Adding to the bullish mosaic is the aggressive insider buying behavior. The C-suite recently executed open market purchases totaling $15 million, heavily clustered around the $95 price level, establishing a formidable technical and psychological floor. Meanwhile, short interest remains heavily suppressed at just 3.2% of the float, suggesting that institutional short sellers recognize the danger of betting against this fundamental momentum. The float is locked up, paving the way for low-friction upward price discovery. As a matter of rigorous equity research protocol, we must stress test our thesis against a comprehensive bear case. The primary downside risk centers on macroeconomic compression. In the event of a severe global recession, aggregate enterprise advertising budgets would inevitably contract, which would compress CPMs and drag down overall platform volume, regardless of algorithmic efficiency. Secondly, we are closely monitoring regulatory headwinds, specifically within the European Union. Escalating scrutiny regarding AI data processing and algorithmic transparency could force costly compliance adaptations or restrict data scraping capabilities. Finally, there is a minor customer concentration risk, with the top 10 enterprise clients accounting for roughly 18% of total revenue. Should these risks materialize synchronously, our models indicate a downside floor and bear case price target of $75, effectively resetting the valuation to industry average multiples. Conversely, our bull case scenario models an asymmetric upside driven by an accelerated margin breakout. If the legacy DSP displacement occurs faster than current consensus estimates, the influx of high-margin enterprise volume could drive EBITDA margins past the 35% threshold by late next year. Furthermore, as third-party cookies officially deprecate, ADI's proprietary probabilistic modeling becomes an indispensable asset, making them a highly attractive mega-cap M&A target. A major tech conglomerate looking to instantly acquire an autonomous ad infrastructure could easily justify a significant acquisition premium. Under these accelerated growth parameters, where revenue compounds at over 35% and multiple expansion aligns with premier AI software peers, our bull case price target extends to $180. This represents an asymmetric return profile of 68% upside against relatively well-defined downside risks. Concluding with the technical setup and trade execution strategy, the chart structure perfectly corroborates the fundamental thesis. The stock has just confirmed a massive 6-month cup and handle continuation pattern, breaking out of the primary resistance zone on 3 times relative volume. This volumetric expansion indicates heavy institutional sponsorship. Furthermore, the 50-day simple moving average has decisively crossed above the 200-day moving average, triggering a textbook golden cross and establishing a bullish long-term trend. Immediate overhead resistance is sparse until the $112 level, while formidable support has been established around the $98 pivot. Given the confluence of accelerating top-line growth, expanding margins, depressed valuation multiples, and an impeccable technical breakout, we are officially initiating coverage with an overweight recommendation. This represents a premier tactical allocation for growth-oriented institutional portfolios.